Okay, so you want to own a shopping mall. In your head, it probably looks something like this. 100 storefronts, every one of them cutting you a rent check on the first of the month. Escalators humming, food court smelling like cinnamon pretzels, teenagers wandering around on a Saturday afternoon spending their parents' money. You picture yourself walking the concourse in a blazer, nodding at tenants like a landlord king, collecting checks while somebody else stocks shelves, runs registers, and deals with customers. No inventory, no cash register, just square footage that prints money while you sip coffee in a corner office overlooks a parking lot. Maybe you picture buying into something like the Mall of America or North Park Center in Dallas, the kind of property where the parking lot is full at 10 in the morning and the luxury wing smells like fresh leather and department store perfume. That version exists. It's just not the version most buyers actually get. Here's the problem. That mental picture is roughly 40 years out of date, and even back then it was more complicated than it looked. The real number that should stop you cold is this. The national mall vacancy rate is now more than double the vacancy rate of retail space in general, and lower-tier malls are sitting close to 13% empty. Nobody shows you that side. Nobody shows you the anchor box that's been dark for 3 years because 5 different owners can't agree on what to do with it. Its old signage still bolted to the facade, weeds pushing up through cracks in 400 empty parking spaces. Understanding why the fantasy and the spreadsheet look nothing alike is worth your time, because the mall business today is really a real estate turnaround business wearing a retail costume.
Let's start with what it actually costs to get in the door. Nobody builds a new enclosed mall in America anymore. Not one has opened since 2019. So step 1 isn't construction, it's acquisition, and you're buying somebody else's problem or somebody else's trophy, depending on the property. A struggling Class C mall in a shrinking metro might trade for $20 to $40 a square foot because the buyer is really purchasing dirt and a demolition option. A stabilized Class A property in a wealthy suburb can trade north of $400 a square foot because you're buying a cash machine with a waiting list of luxury tenants waiting for space. Say you're buying a mid-tier, 700,000 square foot regional mall. At roughly $150 a square foot, that's about $105 million just to close. Where does that number actually come from? Commercial buyers back into a price using something called a cap rate, essentially the unlevered yield the property throws off. Anchor quality retail centers are trading in the mid 6 to 8% range right now, while the best grocery anchored centers have compressed toward 5.75% as institutional money chases anything with reliable cash flow. A mall throwing off $8 million in net operating income at a 7.5% cap rate is worth just over $106 million. Push that same income to a 6.5% cap rate, which happens when leasing momentum improves, and the same building is suddenly worth $123 million. Small shifts in investor sentiment move tens of millions of dollars in value without a single new tenant signing a lease. Then comes the part people underestimate: redevelopment capital. Converting one dead department store box into medical offices or apartments routinely runs $50 to $150 a square foot, depending on how much of the shell you keep. Tenant improvement allowances for new inline stores run another $20 to $60 a square foot because retailers expect the landlord to help pay for their build-out, not the other way around. Add leasing commissions, typically 4 to 6% of total lease value, paid to brokers on both sides of every deal. Add a debt service reserve your lender will demand before they hand over a dime, often 6 to 12 months of payments sitting untouched in an escrow account. And don't forget the appraisal, environmental review, and title work that can run into 6 figures before you've even closed. Your realistic all-in number for that mid-tier mall, once you've stabilized it, lands somewhere between $130 million and $160 million. That's before you've sold a single sweater.
Then there's the paperwork nobody warns you about. A regional mall isn't one building, it's a small municipality, and it gets treated like one. You need a certificate of occupancy for every configuration of every space, fire marshal inspections on a rolling schedule, sprinkler and fire suppression recertification every year, and ADA compliance audits that get more expensive every time the code updates. Ramps, restroom fixtures, parking stall counts, even the height of a service counter can all trigger a retrofit order. In most states, you also need a food service license for every kitchen in your food court, each one inspected separately by the county health department. And a single failed grease trap inspection can shut down a tenant's kitchen until it's fixed, cutting into the sales your percentage rent depends on. In a city like Cincinnati or Sacramento, a mall owner is also negotiating directly with the assessor's office over property tax reassessment almost every year because assessors love arguing that your mall is worth more than your own appraiser says it is, especially right after you've spent millions on a visible renovation. Push back on a reassessment and you're paying for an attorney and an independent appraisal just to defend a number you already thought was settled. Then there are local ordinances around loitering, curfews for unaccompanied minors, and security staffing minimums that vary wildly by city, all of which cost real money to enforce, and all of which can trigger local news coverage if you get them wrong. Co-tenancy clauses, which sound boring, are actually the scariest legal instrument in this business. They let smaller tenants pay reduced rent or walk away entirely if a certain number of anchor stores go dark or if overall mall occupancy pops below a set threshold, often somewhere around 70%. One department store closure can legally trigger rent cuts across dozens of leases you didn't touch. And once a handful of tenants invoke that clause, the drop in visible occupancy can trip the next tier of co-tenancy clauses in other leases entirely on its own. It's less like a wall falling down and more like dominoes you agreed to line up yourself, years before the first one ever tips.
Now for the money that quietly disappears every month, the stuff that never makes it into anybody's daydream. Security staffing for a large enclosed mall commonly runs $800,000 to $1.5 million a year, and that's before you factor in off-duty police officers many cities now require for weekend evening shifts. HVAC alone, keeping 2 million cubic feet of air comfortable through a humid Georgia summer or an Ohio winter, can eat another 7 figures, and a single failed rooftop compressor unit can cost $40,000 to replace on an emergency basis. There's a specific smell familiar to anyone who's worked mall maintenance, the sour, greasy backup of a food court drain trap on a 100-degree July afternoon, right before the plumber shows up and charges emergency rates because it's a Sunday. Insurance premiums on a property this size have climbed sharply in the last 2 years, driven by extreme weather claims nationally, and a coastal or tornado belt mall can now pay well over $1 million a year just for coverage, with underwriters increasingly asking pointed questions about roof age and storm history before they'll even quote a policy. Then property taxes, often the single largest line item of all, frequently exceeding $2 million annually on a mall this size, depending on the state and the assessor's move that year. Landscaping and snow removal add another 6 figures in a northern climate, and parking lot resurfacing every 7 to 10 years can run past $1 million for a lot this large, because 2 million square feet of asphalt doesn't repave itself cheaply. Common area cleaning crews work overnight, buffing terrazzo floors that thousands of feet will scuff again by 10 the next morning. Elevator and escalator maintenance contracts run tens of thousands per unit annually, and an out-of-service escalator sitting behind caution tape for 6 weeks waiting on a specialty part is one of the fastest ways to generate angry tenant emails. On top of all of it sits the marketing fund, money you're legally obligated to spend on mall-wide promotion, whether or not you think that particular Instagram campaign is doing anything. Add it up, and you're often looking at $8 to $12 million a year in operating costs before you've paid $1 of debt service, on a building where half the units might be sitting dark. Here's the trap almost nobody explains clearly. Most of that cost gets passed straight through to tenants as CAM, common area maintenance charges, billed per square foot on top of base rent, which raises an obvious question. If tenants are covering your operating costs, where does your actual profit come from? It's not really the rent. Base rent from an anchor department store is almost laughably small, often just $1 to $4 a square foot annually, sometimes effectively free because the anchor owns its own building outright and simply agreed to operate there decades ago in exchange for driving foot traffic to everyone else. The real profit engine is what's called percentage rent, and it works a lot like an old-fashioned sharecropping arrangement between a farmer and a landowner. A tenant pays a modest base rent, but once their sales cross a negotiated threshold, the landlord takes a cut of every dollar above that line, typically 5 to 8%. A strong luxury boutique doing $1,200 a square foot in annual sales can end up handing the landlord far more through percentage rent than through base rent alone, and the landlord never had to buy inventory, hire a single sales associate, or sit through a slow Tuesday to earn it. Layer on top of that the CAM markup, because landlords are legally permitted to charge an administrative fee on top of actual operating costs, often 10 to 15%, turning your operating expenses from a break-even pass-through into a quiet profit center all by itself. Add parking revenue where paid parking exists, particularly in dense urban malls where a covered spot can run several dollars an hour. Add specialty leasing income from kiosks and pop-up carts that can run $2,000 to $5,000 a month for a tiny 10 by 10 footprint, a rate per square foot that would make a full-size anchor tenant faint if they ever compared notes. Add sponsorship deals for digital screens, seasonal events, and even the naming rights on a food court renovation. None of that shows up in the glossy version of this business, and all of it, together, matters more to the bottom line than the headline number printed on the rent roll. If you're starting to see why this business rewards people who actually run the numbers, you might as well hit subscribe now, because it only gets more counterintuitive from here.
Let's do the math on one single lease, because that's where this business actually lives or dies. Picture a 1,500 square foot apparel store paying $65 a square foot in base rent. That's $97,500 a year coming in the door. Subtract the landlord's share of debt service allocated to that unit, roughly $30,000 on a leveraged property, you're down to $67,500. Subtract the tenant's proportional share of property tax that the landlord still has to remit, even though CAM technically reimburses it, because collections lag and some tenants pay late or negotiate reductions. Call it a real-world leakage of $8,000. You're at $59,500. Subtract deferred maintenance and capital reserves the landlord sets aside for that unit's share of the roof, the HVAC unit, the parking structure, another $12,000. Now you're at $47,500. Subtract leasing commissions and tenant improvement allowances amortized over the lease term, another $9,000 a year. You land around $38,500 in actual net cash flow from a lease that looked like it was worth $97,500 on the rent roll. That gap between the number on the marketing flyer and the number that actually reaches your bank account is the entire game. Now, for a story that shows exactly how this plays out at scale. When Sears was still limping along as a retailer, its former CEO and hedge fund manager Eddie Lampert had already spun off a huge chunk of the company's real estate into a separate company called Seritage Growth Properties back in 2015. On paper, it looked like a strange move, splitting a struggling retailer from its own buildings. In practice, it was the smartest read of this entire industry that decade. The retail business kept losing money quarter after quarter, department by department, region by region. But the real estate underneath those stores, sitting on prime corners in wealthy suburbs across the country, was worth an enormous amount once it was freed from the burden of Sears actually having to operate a struggling store on top of it.
Seritage spent years redeveloping old Sears boxes into mixed retail, restaurants, apartments, and self-storage, unlocking value that the retail operation itself had never come close to generating, even in its best years. Sears, the retailer, eventually disappeared almost entirely, its name now attached to a handful of remaining locations. Seritage, the real estate company, kept extracting value from the dirt for years afterward, before ultimately winding down and returning capital to shareholders once the redevelopment work was largely done. The lesson stuck with a lot of people in this industry, and it's the lesson every mall owner eventually learns, whether they wanted to or not. The store was never really the asset. The land underneath it was. Which brings up the twist most people never see coming. You'd assume the giant anchor department store, the one everyone recognizes, the one with its name on the building, is the biggest moneymaker in a mall. It's usually the opposite. Anchors often pay next to nothing in rent, sometimes nothing at all if they own their box outright, because decades ago, mall developers needed their brand name to guarantee foot traffic and gave away the real estate to get it. Meanwhile, a 400-square-foot jewelry kiosk in the middle of the concourse, paying $150 a square foot plus percentage rent, can generate more profit per square foot for the landlord than an entire 120,000-square-foot department store next door. The biggest box in the building is very often the worst tenant on the rent roll. So let's run two versions of this deal using the exact same starting assumptions. You buy that 700,000-square-foot Class B mall for $105 million, put down 35%, roughly $37 million, and finance the rest at today's commercial rates, around 7% on a 10-year term. In the good scenario, occupancy holds at 92%. Your inline tenants are hitting their percentage rent thresholds, CAM recovery runs close to full reimbursement, and after debt service, your annual free cash flow lands around $9.5 million, an 11% cash-on-cash return on your equity, plus you're building value as cap rates for well-run retail centers have been compressing toward the high fives and low sixes. That's a genuinely good outcome in today's market.
In the bad scenario, everything starts identically. Then one of your two anchors, say a department store chain going through a broader restructuring, announces it's closing its location in year 2. That single event trips co-tenancy clauses across 18 inline leases, giving those tenants the right to renegotiate or exit. 6 of them leave within 12 months, several citing the exact language you or your predecessor signed off on years earlier without fully weighing what it meant. Occupancy drops from 92% to 74%. Percentage rent income evaporates because the tenants generating most of it were disproportionately clustered near the now empty anchor, where foot traffic just collapsed once shoppers stopped having a reason to park at that end of the building. CAM recoveries fall too, since there are fewer tenants left to spread fixed costs across, meaning you're now absorbing security, HVAC, and insurance costs you used to pass through almost entirely. The marketing fund shrinks along with it, right when you need it most to attract new tenants. Your free cash flow doesn't just shrink, it goes negative by roughly $1.8 million a year, and now you're funding debt service out of reserves while you scramble to find a redevelopment tenant, maybe a healthcare system or a self-storage operator, for 150,000 empty square feet that used to sell suits and perfume. The building is physically identical in both scenarios. Same location, same debt, same starting occupancy, same tenants signing the same leases on day one. The entire gap between an 11% return and a cash-negative disaster came down to about 18 percentage points of occupancy, and one anchor's decision made in a corporate headquarters 3 states away, a decision you had absolutely no say in and barely any warning about. What actually separates the mall owners who make it from the ones who lose everything isn't luck, and it isn't even location, though location certainly helps. It's whether they treated the anchor stores as liabilities to be managed, rather than trophies to be proud of. It's whether they read co-tenancy clauses before signing them instead of after an anchor walks out. It's whether they built redevelopment optionality into every lease from day one, so a dead department store becomes an apartment complex or a medical campus instead of a permanent hole in the property.
The owners who survived the last decade of retail upheaval weren't the ones who bet on nostalgia. They were the ones who accepted early that the mall was never really a shopping business. It was always a real estate operating business that happened to rent space to people selling sweaters. And the sooner an owner makes peace with that, the sooner the spreadsheet starts making sense. If this kind of breakdown is useful to you, stick around and subscribe, because there's a lot more of this industry left to take apart.